So this is Baz and Moz for the Global RE Bitcoin. And we're doing today a podcast about the value, the intrinsic and the extrinsic value of cryptocurrencies. Um, value, Harry. What comes to mind when I say intrinsic value in cryptocurrencies, and particularly altcoins here, like
So,
fencing?
so there's obviously a school of thought that says that the value of an asset is the last price paid for it by anybody, right? That's one way of thinking about an asset. The second is the value of an asset is all the projected rate returns that you're going to get over a period of a certain number of years, and then you calculate that backwards.
Seven, is it generally? Or
sort of a discounted
traditional business models, we generally think of 7-year
something
projections.
Like,
or,
yeah. And then you sort of discount that backwards and say, okay, so the value of this asset is 7 years from now, it's going to give you $100. We discount that by a certain amount and add this.
And that equation just doesn't hold water here in crypto space, does it? I mean,
well, no. So this is for any value, right? Any asset you're trying to value, you think about it either in terms of the last price or what it might give you in return, or you do some combination of those two things. With cryptos, there's the cryptos are perhaps something like stocks sometimes, where you're speculating on what might be the value of the asset 2 years from now based on expectation. You've looked at the graph of Ethereum, you've looked at the graph of Bitcoin, and you say, okay, this is going to continue to go up just because of demand, just because of hype. So this is the sort of scenario where you were looking at stocks on the in 1999 before the crash in 2000, and you're saying, well, it's been going up like nuts for the last 4 years. We think it's going to keep going up, right? So that might be, so your notion of value may be value holding it for 6 years, value holding it for 3 months. It all depends. The problem with the whole idea of value holding it for 3 months or thinking that the graph is going to climb is there are just a lot more assumptions. Everybody's making assumptions as to what the value of an asset is.
As the value is going to climb, haven't you read our white paper?
Well, every asset, I mean, obviously, there are good reasons to think that cryptos will go up in value in general. Mm-hmm. But the big question is which crypto will continue to rise, and will there be a correction and then a continuation of that rise? And also, fact is that if Bitcoin is going to replace the US dollar as the reserve currency of the world, that doesn't necessarily mean the value of Bitcoin is going to climb exponentially constantly. Just more people using it doesn't cause a crypto to necessarily rise exponentially. The US dollar hasn't risen that much, right? They make the US Treasury, the US country makes money off the US dollar being a reserve currency, but it's not like gold. You can either think about it as is Bitcoin going to be the new US dollar, or is it going to be the new gold?
Right. I think easing measures would also have something to do with the value of the US dollar here in that context.
But so that's for cryptos in general, right? But then suppose you say, well, I don't want to be so crazy and so open-ended in my thinking about cryptos. I want an asset that I can value on a 7-year basis and figure out. I want an asset that I can actually more predictably think about. And so that's sort of going to result in the rise of the asset-backed cryptos, because they're kind of boring versions of these other things, more boring, predictable versions, and we are busy trying to be boring.
We're busy trying to be boring. I think that's worth snapping up. So there's going to be this interaction whereby there's intrinsic crypto value and there's also the asset-backed value, and these swings in both of those that contribute to So
we're not even being so ambitious as to claim to people that our token is going to be X because of its use as a currency, as a merchant acceptably, a currency acceptable by merchants. Now that could just cause the value to skyrocket, but that's not even part of our pitch. I mean, we'll be very, very basic in our thinking, saying, okay, we're going to take this, we're going to take funds, we're going to invest them in assets, real assets, base our crypto on that, and even with those assumptions, our crypto value is going to rise. Our crypto asset is going to generate enough returns.
So our value is the safety and security of the coin itself.
Yeah, of the base behind the coin.
I don't know if you've seen it, but one of my favorite coins is this basic attention token. What these guys have done is they've launched their own browser.
Basically, they thought of your idea before you did. As I remember.
That idea, that when we were drunk in Copenhagen.
Yeah.
That would, yes, they might have. Yes,
because I looked at that and I was wondering if you got your idea out of that and pretended it was yours.
I think there would be a means to put in a physiological measurement on top of their Brave browser there.
Oh, okay.
Quite literally by having an eye tracker, a non-eye level eye tracker under the screen. Hey, I'm taking a tangent there.
That's okay. That's okay. So basically,
but I hate it when people steal your ideas before you have them. This happens a lot in my life.
So this basic attention token. What brought you to that?
Well. Here we have actually a very nice and sophisticated use of blockchain technology, and that's what's driving their value. They've increased 200% in the last week, really.
Well, the thing
they're
about
up to 60% now. Yeah,
but anybody who says that we're using blockchain to derive value, I always just get a little worried because the code base of these blockchains is so immature. It's 2-3 years.
So here's these two divergent branches of value.
Yeah.
One is that it's safe and secure, and that it actually can support being there for the long haul, if that's 2 years or 5 years or 10 years.
Yeah.
The other one is that it's a driver, a value, an innovation driver for value.
Yeah, and maybe they've done some nice stuff with the blockchain, found a way to, and sure, we're doing some nice stuff as well. We're using some very basic features of the blockchain, basically using it as a register, and using its sort of worldwide reach to sort of provide access to people around the world to disintermediate a bunch of market players. So we're also using the blockchain, but these guys might be doing, going that step further, which for us might be a little risky. We may not want to take the risk of putting too much investor value at risk in the blockchain. We're taking a sort of a much more conservative view on that.
So, Baz, what are your thoughts on the platform? The platform as a driver of value in cryptocurrencies.
The thing about
creating a platform. Yep.
We could, I don't know, we could go on for how long does this podcast go for? But platforms are interesting because everybody wants to build a platform. Everybody wants to build a platform so they can charge a platform fee to everybody else who wants to get on them. And that's just great. That's your classic rent-seeking behavior, which is fine.
Rent-seeking
behavior, right? Ricardo's theory of rent. Classic rent-seeking behavior. But the thing is that everybody wants to do it. And so you have to be really good at building platforms to get other people, to force other people on there. And you have to have really high barriers to entry, And your high barrier to entry may be your ability to execute good product, good software. But anybody can tell you, I'm building a platform. Great. In life, everybody's building a platform. And everybody's inviting other people to their house for a party. But are you good at throwing parties? How good a host are you? Right? That's the thing about building platforms. You want to be the guy that everybody goes to. You want to be the guy with the house that everybody goes to for the party. Right?
Like the iTunes store was for app developers.
Yeah. But I've tried. Maybe you're not. Maybe I'm not the guy. I'm not the guy that everybody goes to for the party. I'm not the best host in the world, right? So maybe I shouldn't be building a platform. And the other thing is,
we could use the royal we there as well. But
yeah, we could.
It's not just about you and
me. Well, I was just trying to, no, I didn't want to cast
us versus them.
I didn't want to cast aspersions on your ability to host a party. But to come back to platforms, that's one thing. And then there's the whole business of building it out, and who's going to pay for it? I mean, are you going to make your investors pay for your platform? I mean, everything is a platform in the sense that ICO is a platform. But if you're going to build a platform on top of a platform, so let me get this straight. You're getting your investors to pay for your original platform because you kept some founder coins aside. And then now you're going to get them to pay for a platform on top of that. And then they've got to hope that you go and find people that'll get onto your platform. I mean, all that seems like, wow, geez. You could just tokenize an asset directly. There are guys who've tokenized themselves, right? David, you could issue.
Are we talking the Yuri coin, not the Dave coin?
No, yeah, you could. There's a guy, programmer, who just tokenized his time and issued coins. And if you want to hire him, you pay him in his coins. So there are very good ways to tokenize assets directly. My question is, why do I have to go and listen to some dude who's promising me a platform, right?
A question here about value again, and articulation of the crypto world out in the real world here.
Yeah.
Surely that interface costs money to maintain.
Yeah.
Yes, we have our wallet, and yes, we store things in there, and yes, we go to the exchange and we exchange fiat for crypto. But over and above that first exchange, there must be a cost function associated with more interchanges there between crypto space and real life space, or whatever we like.
Coffee, please. Just
coffee, sir. Yes, allow me.
But you see, of course, there's transaction costs, right? There's transaction costs between cryptos, thanks, and then there's transaction costs between crypto and fiat, and then there's transaction costs in the fiat world when you're dealing with assets. But the interesting thing is that the reason cryptos are getting so popular is because the transaction cost in cryptos is small. The transaction cost there's friction between crypto and fiat, which is getting lesser and lesser every day. So what you're doing is you're basically taking this long chain of real world transactions across the world, and then you're just smoothing it out with one or two transaction layers, which are in and of themselves cheaper than their real world counterparts. So it's yes, there's still transaction costs. Nothing is frictionless, but this is way better. This is fantastic compared to the existing solution, right?
That might be a very good place to leave it there, Baz. Thanks for Baz and Moz on a wet and grey Wednesday morning signing out.